Economics.
Chapter: Demand-side and supply-side policies. Distinguish between expansionary and contractionary monetary policy. Expansionary monetary policy is used by a central bank to stimulate economic activity during times of low growth or recession. It involves increasing the money supply and lowering interest rates to boost aggregate demand, with the aim of reducing unemployment and increasing output. In contrast, contractionary monetary policy is used to reduce inflationary pressures when the economy is overheating. It involves decreasing the money supply and raising interest rates to reduce AD, thereby lowering inflation but potentially slowing growth and increasing unemployment. State the components of aggregate demand that monetary policy can influence. Monetary policy primarily influences the following components of aggregate demand. Consumption, through changes in interest rates that affect borrowing and saving decisions. Investment, as interest rates affect the cost of borrowing for businesses. Net exports, because interest rate changes affect exchange rates, which in turn influence export and import levels. Explain the role of the rate of interest in monetary policy. The interest rate is a key tool used by central banks to regulate economic activity. When a central bank lowers the interest rate, borrowing becomes cheaper, and saving becomes less attractive. This encourages households to increase consumption and firms to increase investment, boosting AD. This is the core mechanism in expansionary monetary policy. Conversely, raising interest rates makes borrowing more expensive and encourages saving, which reduces consumption and investment. This helps reduce inflationary pressure, which is the goal of contractionary monetary policy. Thus, changes in interest rates directly affect two key components of aggregate demand. One is consumption and other is investment.
Thanks for watching. Subscribe to our channel for such educational videos.